Mutual funds, at their core, are one of the most practical and democratic ways for ordinary individuals in India to participate in wealth creation through financial markets without requiring deep expertise in stock picking, bond analysis, or market timing. Because a mutual fund is essentially a professionally managed investment vehicle where money from thousands or even millions of investors is pooled together and invested in a diversified portfolio of assets such as equities, debt instruments, money market securities, gold, or a combination of these depending on the fund's stated objective. And in India, this entire ecosystem operates under the regulatory supervision of the Securities and Exchange Board of India, SEBI, which exists to protect investors, enforce transparency, and ensure that fund houses follow strict disclosure and risk management norms, making mutual funds significantly safer and more structured than many informal or speculative investment avenues that Indian households have traditionally relied upon. When an investor puts money into a mutual fund, they are allotted units that represent their proportional ownership of the total portfolio, and the value of each unit is determined by the net asset value, or NAV, which is calculated daily after market hours by taking the total value of all assets held by the fund, subtracting liabilities, and dividing the result by the total number of outstanding units. And while beginners often obsess over NAV as if a lower NAV makes a fund cheaper or more attractive, in reality, NAV is merely an accounting figure and has no bearing on the future return potential of a fund, because what truly matters is the quality of underlying assets, the investment strategy, the discipline of the fund manager, the expense ratio, and how well the fund aligns with the investor's financial goals, risk appetite, and time horizon. To understand how money is made through mutual funds in India, one must first grasp that returns come primarily from two sources: capital appreciation and income generation, where capital appreciation refers to the increase in value of the underlying securities over time, such as stocks growing as companies expand profits or bonds appreciating due to falling interest rates, while income generation comes from dividends paid by companies, interest earned on debt instruments, or coupon payments from bonds, all of which are either reinvested into the fund or distributed to investors depending on the fund's structure and payout policy. Though in modern Indian mutual fund investing, the growth option, where all income is reinvested to compound returns over time, is generally preferred over dividend options due to tax efficiency and superior long-term wealth creation. The Indian mutual fund universe is vast and can broadly be categorized into equity mutual funds, debt mutual funds, hybrid funds, solution-oriented funds, index funds, ETFs, and thematic or sectoral funds, each serving a different purpose. And equity mutual funds are typically the primary vehicle for long-term wealth creation because they invest predominantly in shares of listed companies across market capitalizations such as large-cap, mid-cap, and small-cap stocks, offering higher return potential but also higher volatility, whereas debt mutual funds invest in fixed-income instruments like government securities, corporate bonds, treasury bills, and commercial papers, aiming to provide relatively stable returns with lower risk compared to equities, making them suitable for conservative investors or for parking money for short to medium durations. Hybrid funds blend equity and debt in varying proportions to balance risk and return, while solution-oriented funds like retirement or children's funds are designed with lock-in periods to encourage long-term goal-based investing. And index funds and ETFs simply replicate market indices such as the Nifty 50 or Sensex, offering low-cost, passive exposure to the market without attempting to beat it. A strategy that has gained immense popularity in India in recent years due to increasing awareness of the difficulty most active funds face in consistently outperforming benchmarks after costs. Making money with mutual funds in India is less about clever timing and more about discipline, patience, and alignment with financial goals. And this is where concepts like systematic investment plans or SIPs play a crucial role, because SIPs allow investors to invest a fixed amount at regular intervals, usually monthly, which not only instills financial discipline, but also leverages rupee cost averaging, meaning that more units are purchased when markets are down and fewer when markets are high, thereby smoothing out the average cost of investment over time and reducing the psychological stress associated with market volatility. And this approach has proven especially effective in the Indian context, where markets can be volatile due to global cues, domestic economic cycles, political developments, and investor sentiment, yet tend to grow over long periods as the economy expands. Corporate earnings rise and productivity improves. However, the ability to make meaningful money from mutual funds depends heavily on understanding one's own risk tolerance and time horizon, because an investor who panics and exits equity funds during market crashes is unlikely to benefit from long-term compounding, while someone who remains invested through cycles often experiences the exponential growth effect, where returns start generating returns, a phenomenon famously described by Albert Einstein as the eighth wonder of the world. And in India, this compounding advantage is further enhanced by the country's demographic dividend, rising middle class, increasing formalization of the economy, and growing participation in capital markets through digital platforms and fintech innovations. Taxation is another critical aspect of making money with mutual funds in India, because post-tax returns are what ultimately matter, and equity mutual funds enjoy favorable tax treatment where long-term capital gains exceeding 1 lakh per year are taxed at 10% without indexation if the holding period exceeds 1 year, while short-term gains are taxed at 15%, whereas debt mutual funds, following recent tax changes, are now taxed as per the investor's slab rate if held for any duration, which has reduced their tax advantage compared to earlier years, making it essential for investors to choose funds not just based on pre-tax returns, but also on how they fit into their overall tax planning strategy. Despite their many advantages, mutual funds are not risk-free and come with certain downsides that investors must acknowledge, because market-linked instruments are inherently subject to volatility, economic downturns, interest rate changes, credit risk, and liquidity risk, and even the best managed funds can experience periods of underperformance, particularly during market corrections or sector-specific downturns, which means that mutual funds are unsuitable for investors who require guaranteed returns or capital protection over short durations. And there is also the risk of choosing the wrong fund or investing based on past performance alone, without understanding the underlying strategy, expense structure, or portfolio concentration, which can lead to disappointment and suboptimal outcomes. Moreover, while professional management is a key benefit of mutual funds, fund managers are still human and can make incorrect calls, and frequent churn in fund management teams or changes in investment philosophy can impact consistency, highlighting the importance of periodically reviewing one's portfolio, rather than blindly investing and forgetting forever. On the positive side, mutual funds offer unparalleled diversification even with small amounts of money, because an investor with just a few thousand rupees can gain exposure to dozens or even hundreds of securities across sectors and geographies, something that would be nearly impossible to replicate through direct stock investing without significant capital and expertise. And this diversification reduces unsystematic risk, making returns more stable over time. While liquidity is another major advantage, as most open-ended mutual funds allow investors to redeem their units at NAV within a few business days, providing access to funds when needed, unlike traditional instruments such as fixed deposits with lock-in penalties or real estate which can take months to liquidate. In the Indian context, mutual funds have also become increasingly accessible due to initiatives like direct plans, which allow investors to bypass distributors and save on commission costs, resulting in higher net returns over time, as well as digital KYC, mobile apps, and online platforms that have simplified investing for first-time investors from Tier 2 and Tier 3 cities, thereby expanding the investor base and making mutual funds a central pillar of household financial planning, rather than a niche product for urban elites. Making money with mutual funds in India in a practical, repeatable way depends less on chasing the highest performing fund of the past year, and more on constructing a simple, goal-oriented strategy that respects time horizon, risk capacity, and behavioral discipline. Because most investors do not fail due to lack of options, but due to emotional decisions such as entering the market after rallies and exiting during crashes. And a well-designed mutual fund approach seeks to eliminate these behavioral errors by systematizing investments and setting realistic expectations. The first and most important principle is goal-based investing, where money is allocated not abstractly but for specific purposes such as retirement, house purchase, children's education, or wealth creation, since each goal has a different time frame and risk tolerance. And in India, equity mutual funds are best suited for long-term goals of at least 5 to 7 years or more because short-term market volatility can distort outcomes. Whereas debt or hybrid funds are better for shorter goals, where capital protection and stability matter more than aggressive growth. A second key principle is asset allocation, which simply means deciding how much money should go into equity versus debt versus other assets like gold. And this decision alone often determines most of the eventual returns and risk profile, far more than individual fund selection, because an investor with a high equity allocation during their early earning years can tolerate volatility and benefit from compounding, while someone nearing a goal or retirement should gradually reduce equity exposure to protect accumulated wealth, a process known as rebalancing, which involves periodically adjusting the portfolio back to its intended allocation when market movements cause deviations. SIPs play a central role in this process, not because they guarantee profits, but because they enforce consistency and reduce timing risk. And in India, where salary cycles are monthly and cash flows are predictable for many working professionals, SIPs fit naturally into personal finance habits, allowing investors to build significant portfolios over time without feeling the psychological burden of lump sum investing. Though it is important to note that lump sum investments can also be effective when markets are reasonably valued, or when large sums such as bonuses or inheritance are involved, provided the investor has the temperament to stay invested. Fund selection itself should be based on a combination of factors including consistency of performance across market cycles, expense ratio, portfolio diversification, fund house governance, and clarity of investment philosophy rather than short-term returns. Because a fund that performs well only in bull markets but collapses during corrections can do more harm than good. And in the Indian context, investors should generally avoid overexposure to thematic or sectoral funds unless they have strong conviction and understanding, as these funds are cyclical and can underperform for long stretches, while diversified equity funds or low-cost index funds often deliver more reliable long-term outcomes. Costs, though often overlooked, play a significant role in wealth creation, because even a small difference in expense ratio can compound into a large gap over decades, which is why direct plans have become increasingly popular among informed Indian investors, as they eliminate distributor commissions and improve net returns without changing the underlying portfolio. Another crucial factor is taxation, and while equity mutual funds remain tax-efficient for long-term investors, frequent churning or switching between funds can trigger unnecessary tax liabilities and disrupt compounding, making patience a more profitable strategy than constant optimization. And this is especially relevant in India, where policy changes can alter tax treatment, reinforcing the need for flexibility rather than over-reliance on any single tax advantage. On the downside, mutual funds expose investors to market risk, meaning portfolio values can decline sharply during economic slowdowns, global crises, or domestic disruptions. And while history shows that markets recover over time, the waiting period can test investor confidence, particularly for first-time investors who have not experienced full market cycles. And there is also the risk of underperformance relative to benchmarks, as not all fund managers succeed in adding alpha consistently, making passive investing a sensible default choice for many. Liquidity, though generally good, can sometimes be constrained in extreme market conditions, and debt funds in particular can face credit risk if underlying issuers default, a reality that became visible during past credit events in India, reminding investors that even supposedly safe instruments require due diligence. Yet despite these risks, the advantages of mutual funds remain compelling, especially in a country like India where financial literacy is still evolving, because mutual funds offer transparency through regular disclosures, flexibility through SIPs and redemptions, scalability from small amounts to large portfolios, and alignment with long-term economic growth, making them an effective bridge between household savings and productive capital. Ultimately, mutual funds are not a shortcut to quick wealth, but a structured pathway to long-term financial independence. And investors who approach them with realistic expectations, patience, and a focus on process rather than prediction are far more likely to succeed than those who treat them as speculative instruments. Because the true power of mutual funds in India lies not in beating the market every year, but in staying invested long enough for the market to work in their favor. At a more advanced level, making money with mutual funds in India requires investors to move beyond basic selection and understand how behavior, expectations, and macroeconomic alignment influence outcomes over long periods. Because even the most well-constructed portfolio can fail if the investor repeatedly reacts emotionally to news cycles, market corrections, or short-term underperformance. And this is where realistic return expectations become critical. As Indian equity, mutual funds have historically delivered long-term returns in the range of 11 to 14% annually over full market cycles, rather than the exaggerated figures often promoted during bull markets. And accepting this reality helps investors avoid disappointment and overtrading, while also allowing them to plan contributions and timelines more accurately. A common myth in India is that switching funds frequently based on recent performance improves returns, but in practice, this often leads to buying high and selling low, incurring exit loads and taxes, and disrupting compounding, whereas staying invested in a reasonably good fund through periods of underperformance often yields better results because markets and styles rotate, and no single strategy outperforms all the time. Another widespread misconception is that small-cap or mid-cap funds are inherently superior because of their potential for higher returns. Yet these categories also experience deeper drawdowns and longer recovery periods, making them unsuitable as core holdings for most investors, especially those with moderate risk tolerance. And a balanced approach that combines large-cap or index funds for stability with limited exposure to mid- and small-cap funds for growth often produces smoother outcomes. Timing the market is another trap, as many investors delay investing while waiting for corrections that may not come, or exit entirely during crises fearing further losses, only to miss the strongest recovery phases. And this behavior is particularly visible in India during global shocks or domestic political events, reinforcing the importance of automation through SIPs and predetermined asset allocation rules. From a strategic perspective, rebalancing is one of the few proven ways to enhance risk-adjusted returns without forecasting, because it forces investors to trim assets that have run up and add to those that have underperformed, countering emotional biases, while goal-linked portfolios help prevent the mistake of taking excessive risk with money needed in the near term. Inflation is another silent factor that mutual fund investors must account for, as nominal returns can appear attractive but real purchasing power matters more. And equity mutual funds, despite volatility, remain one of the few instruments capable of beating inflation consistently over long periods in India, whereas over-reliance on traditional savings products can lead to wealth erosion despite apparent safety. The pros of mutual funds become particularly clear when viewed through a life cycle lens, as they allow young investors to start small-scale investments with income growth, adjust risk over time, and eventually transition to income-focused strategies without changing the fundamental investment framework, while transparency, regulatory oversight, and ease of access further strengthen their appeal. On the flip side, mutual funds demand patience, financial literacy, and emotional resilience, and they do not protect investors from their own worst instincts, nor do they eliminate systemic risks such as prolonged bear markets or structural economic slowdowns, meaning they are tools rather than guarantees. In the Indian context, where financial goals are often intertwined with family responsibilities, social expectations, and uneven income patterns, mutual funds work best when integrated into a broader financial plan that includes emergency funds, insurance, and realistic cash flow management, rather than being treated as isolated return-generating products. In conclusion, mutual funds in India represent a powerful yet disciplined way to participate in economic growth, offering a balance between professional management and individual control. And while they come with market-linked risks and require consistency, their ability to convert regular savings into long-term wealth through diversification, compounding, and structure makes them one of the most effective financial instruments available to Indian investors today, provided they are used with clarity, patience, and respect for both their potential and their limitations. Based on recent return data and performance rankings, returns and rankings change over time. This list combines several sources to highlight funds that have delivered strong performance over the past 5 years. Past performance is not a guarantee of future results and should be one of several factors you consider. Top 10 best performing mutual funds in India currently. Quant Small Cap Fund, Direct Growth, one of the leading small-cap equity funds with high long-term returns historically. Kotak U.S. Specific Equity Passive FO/F Direct G, international equity fund with very strong recent returns. HDFC Gold ETF Fund of Fund Direct G, gold-linked fund, topping returns in 1 year and multi-year performance. SBI PSU Fund, strong long-term equity returns, especially over 5-year CAGR rankings. ICICI Prudential Infrastructure Fund, consistent performer over long horizons focused on infrastructure equities. Aditya Birla SL PSU Equity Fund, another high 5-year CAGR PSU-oriented equity option. Nippon India Small Cap/Small Cap Funds, small cap category leaders with strong recent total returns. HDFC Balanced Advantage Fund Dynamic Hybrid that has delivered solid returns with lower risk. ICICI Prudential Liquid Fund Direct G, top performer among liquid debt funds, important for conservative allocation. Bharat Bond FOF, April 2031 Direct G, leading debt-oriented fund bond ETF linked, suitable for stability and fixed income goals. These funds span different categories: small cap, PSU equity, infrastructure, gold, hybrid, liquid, and debt. Because the best mutual fund depends heavily on your risk tolerance, goal horizon, and asset allocation need. Large cap, multi-cap, and index funds are also widely recommended, but aren't all captured in short-term high-return lists. For long-term investing in India, consistently top-ranked categories historically include quality small-cap and thematic equity funds as well as disciplined hybrid funds, though diversification across categories and risk profiles tends to outperform bets on a single best fund.